activities. So I will just give a brief again on this topic. All right, under this chapter 6, we are actually looking at a business that have goods, all right, that sell goods. So when you sell goods means that you have to understand how actually the recording, the accounting records of a company that have merchandise. Yeah, because when talking about merchandising, it involves inventories, right? So inventories is main lah. So without inventory, you cannot make sales, right? Without sales, you don't actually have any business. So what we're doing that is that the topic is that looking at in the cycle, for example, you know that you have to purchase your inventories and then you have to sell your inventories. Yeah, you purchase from your supplier and you sell to your customer. So the concept is already there. It's just that how are we going to record, right, accounting, right, for the purpose of these merchandising activities. All right. So in this topic, they're actually looking at, all right, retailing, all right, merchandising activities to actually sell goods. So it means that we are not actually looking at those companies that manufacture goods. All right, only those who actually sell goods, they buy from supplier and they sell to customers. So how are you going to record the purchasing? How are you going to record the sales of the inventory? Right? And then you know that when you purchase from your supplier, normally we call it as a goods at cost. All right, so that is your cost of the inventory. And but when you sell to your customer, you sell at profit. Right, so sell at profit, we call that as a sales. So you're going to compare between your sales and your COGS. All right, then you'll see that you will have your profit here, all right? And the profit that you compare between your sales and your COGS is known as gross profit. Yeah. Just before the class, I tried the fan. It works well, but now it doesn't look good. All right. I'm not sure why. Okay. Okay. Never mind. I don't want. Okay, and then all right, in terms of the system, right? So we're talking about inventory. So how is the system of the inventory? So we have two types of system here. We call inventory system, whether you go for the perpetual or you go for the periodic. All right, in the slide that shows you which company that should go for perpetual inventory system, which company that should go for periodic. So I think that I went through the slides earlier, all right, in the video just now. And on top of that, this topic will also look into, all right, what happened when there is a returns. All right, returns here means that it's very common whether you can have a purchase returns, it could also be a sales return. So what happened on the purchase return is that you purchase from your supplier and then you find that the merchandise does not fulfill or there could be some damages, right? So you return the goods to the supplier. So here you have to understand what is actually happening. When you first purchase, inventory comes into your business. Yeah, but then when you return the purchaser, it goes out from your business. So you have to understand, all right, previously you record purchase and your inventory comes in and then you have your accounts payable, but now you returns the good to your accounts payable, so account payable should goes down, right? And then it reduce your liability. And the purchase return means that your inventory in the business now reduces because why? Whatever you have now, you returns to your supplier. It may not be the whole lot, it could be some of it could be very small number, but you have to record those purchase returns. Similarly, when you make sales to your customer, all right, you may have sold goods which are not in accordance to the contract, for example. So the customer say, no, I want to return the goods. So when the customer returns the good, means that the inventory comes back to the business. Yeah, so it means that now initially you have account receivable, but now because they returns the good, it seems that macam dia punya accounts receivable reduces. All right, so they mean initially maybe the sales was 100, you open account receivable 100, but now because they return 20 value of the sold sales, all right, so now you have sales return of 20, so you have to reduce your account receivable by 20. Yeah, and of course, this chapter also look into the normal activities in a business. We give you discounts. All right, it means that it could be accounts payable. when you want to purchase goods or supplies from your accounts payable or from your supplier, in order to encourage you buy more, right, or encourage you to pay them earlier, they will give you discounts, right? So these discounts, all right, for example, you're talking about your supplier, all right, when you buy your inventory, whenever you have discounts reduce your costs, isn't it? For example, it could be the inventory initially was 100, but because of the discounts of 10%, now you only have to pay 90. All right, so the 10 ringgit there is what we call discounts. And when you receive the discounts here is a revenue. So we call it as a discounts received, right? That is on the first part. But you also have to look at if you make sales, or in order for you to encourage your customer to pay you as soon as possible, in order to encourage your customer to buy a lot more, you may give them discounts. So in this case, these discounts allow, so discount that you give to your customer. So in this case, the discounts is an expense to you, right? It's a contra. It's no longer it's no longer a sale that it reduce your sales value, yeah, because you give discount. For example, it maybe the sales was 200, but because you give 10% discount of 20, so now customer only pay you 180 instead of 200. So that's when, how are we going to record whenever there's a discount given either by the supplier or the company, all right, to the customer. All right, and the final part of the textbook, it looks into the financial statement analysis in relation to merchandising activity. It means that from the financial statement, you can actually look at the net sales of the company. All right, so for example, net sales means that your sales minus your sales return. So if your percentage of net sales is very high, all right, it shows that why there are so many returns. So you must look into the issues related to the returns. Is it the goods that you sell is below quality, all right, or most likely it's like that, all right, or there could be damages that you do not actually realize, all right. So these are the things that you want to look into when you have merchandise, because in the merchandising activities, inventory is the main item, all right. And remember that the inventory is your current asset, yeah. So you have to look after your inventory, and then for example, you also want to look at the gross profit margin, all right. If the GP margin means that the gross profit is your sales minus your cost of goods sold, all right. So please lah, I think it's not working, I don't know. All right, your gross profit margin is your sales minus your cost of goods sold. All right, if your gross profit margin is very high, then it means that it's good lah. Means that sales is high, cost is low. So it means that your profit is very large. Yeah, so it's good. But if your gross profit margin is very small, then you have to look at what is wrong. What are you not selling your goods at a sufficient profit, for example, because if the gross margin is very small, all right, maybe you may not be able to support your operating expenses. So these are the things that are covered in this chapter, right? I may not be able to go through all the example in the textbook, all right, but if you go through all these slides, all right, you should be able to understand the topic very well. Yeah, so I just want to look into the example, right? Perpetual inventory system here. Okay. All right. In this case, all right, we are looking at perpetual. Remember that later we look into the periodic itself. Yeah. But whether it's a periodic or whether it's a perpetual, you have to understand what is actually happening. All right. Whether inventory comes into your company or inventory goes out from the company. Right. Whenever inventory, remember inventory is an asset. So whenever inventory is, then you have to increase your inventory accounts. Yeah. But if you sell, all right, the goods, then the inventory goes down. So that's what a perpetual inventory monitor. All right. So for example, here we have a purchase region 21-inch computer monitors on account from Okawa. All right. The monitor costs 600 ringgit each for a total of 6,000. Payment is due in 30 days. So when you see that there's a payment due in 30 days, you know that there is an accounts payable. You're going to pay that later, not now. Yeah. So you're going to debit your inventory. So because why? When you purchase from your supplier, you have that inventory. So it means that now you have increased your inventory account. So debit your inventory and credit your accounts payable. So far so good?
Yes, ma'am.
Yeah. All right. Then the next one is that, all right, so remember that the cost, so this is what we say, the cost. All right, the cost of the monitor is 600 ringgit per unit. You have to remember that because that is the cost of your inventory. Yeah. So when you purchase, this would be the entry. So I have actually made a summary of this. I will share this with you later. All right, between the inventory system between perpetual and periodic. So when you purchase an inventory, these are the entry: debit your inventory, credit your accounts, payable. Right. So look at the perpetual first. Don't look into the periodic yet. Yeah. Okay, so next is that the next example is the company sold two computer monitors for 1,000 per unit on account. So when you have, all right, where is perpetual just now? Right. So when you make sales in the perpetual system, there must be two entries. Right, two entries here means that number one is that to record the cost of the goods. Right. So remember that how much was the cost of the computer just now?
300 per
600
monitor.
per unit kan. So
Per
cost is
unit, yes.
600. So you have to record the cost now. Alright, you now because bila you sell namanya cost of goods sold. Alright, so you must record the cost of the goods that you sell. In this case, how much the cost? 600 per unit and you sell 2 units. That's why you have to put into what we call debit your cost of goods sold account, COGS, 1,200.
Yes.
All right. And credit inventory. Why you credit your inventory? Any
Because
idea? Why you credit
the
inventory?
the
What
value
happened when
of
you
the
sell? Huh? What happened to the inventory when you sell? Inventory increase or decrease?
decrease.
Decreases kan, means
Yes.
that bila you sell you have to bring out that inventory from your business. So the inventory initially it was 6,000, now decreases, right, by 2 units. So so you kena take it out lah, take out from the inventory account. That's why you credit your inventory, but the inventory is recorded at cost, so you have to credit 1,200. Yeah, so that is to record the cost of the inventory. All right, the COGS is the cost of the inventory, and you credit your inventory accounts to reflect the movement of the inventory. Right
So that
now,
means we
yeah,
should put the cost amount.
yeah. The first part, the first one is cost. That's why namanya cost of goods sold. Berapa cost of the goods yang you sell? So you have to record that at cost. And inventory,
1,200.
masa you beli kat atas ni, when you purchase the inventory, you purchase at cost. And you
Yes.
record the inventory at cost juga, betul?
Yeah, yes, yes.
So your inventory will always at cost. But under perpetual system, you ada lagi satu another transaction they have to do. That's why namanya ada A and B.
A and
Yeah.
B.
So A and B, it means that the second one is that you have to record the sales itself. Sebab sales is not at cost. Bila you jual, you must jual at profit.
With profit,
Alright,
yes.
so kita
Yes.
panggil selling price. So that's why your selling price is. So in this case, you sell at 1,000 per unit. So the sales is 1,000 times 2 is 2,000. But what are the respective accounts? So below you make sales, all right, you remember that you have to record the selling price. So the 2,000 is your sales. All right, 2 times 1,000 selling price is credit sales 2,000. Kenapa credit sales? Because sales ni revenue. That's why they credit, because sales or revenue increase your honest equity. So that's why the nature of sales account is a credit, right? But then you know that when you make sales, you're going to receive cash of 2,000. All right. So if you receive cash 2,000, you debit your cash lah. But if you make sales and then customer will only pay you later, then you are going to create accounts receivable.
Account receivable.
And so you either debit your cash or debit your account receivable and credit your sales. So under perpetual, all right, whenever there's a sales, kena ada two entries. One is to record at cost, the other one is to record the sales at profit. Do you get that? So if you look at here, all right, below you the sales, when you sell your inventory, there will be two entries that you have to put in. All right, debit your COGS, credit your inventory, and debit your cash or account receivable and credit your sales.
Yes.
Okay. Next is what is next? Next is okay. In this case, you say that when you pay, all right, your company, Computer City paid Okawa. Who is Okawa? Okawa Wholesale Company.
Who say the computer to
Who is this? Your accounts payable lah. Remember just now you purchase from Okawa ni? You first purchase 6,000, now you want to pay. Bila you pay means that cash out lah. So credit your cash and debit your accounts payable. Why you debit your accounts payable?
So mean account payable decrease.
Accounts payable decreases, that's why you debit your accounts payable and credit your cash. Because why you pay out cash? Alright, because you pay your supplier. Right, you pay Okawa Wholesale, then you have to pay out cash lah. Okay, so that is when you make payment. So maybe I can put here purchase, and then let me put in payment of accounts payable. So here you are going to debit accounts payable, and you are going to credit your cash, right?
Okay.
Whether it's under perpetual, it will be the same. Yeah, so it will be the same.
Prediction.
All right, and then next example is that you say that perpetual here you collected. So you collect means that you collect from whom? How much you collect? 2,000. From whom? From your accounts receivable.
From the buyer. Oh, from account receivable.
From your customer. Yeah, account receivable. So means that if you receive cash, you collect cash, you debit your cash lah. And you credit your account receivable because now, all right, initially you created account receivable 2,000, but now account receivable paid you, so now that's zero rise dari account receivable. If you look into the T account, that's zero dah dia punya balance because mula-mula you debit 2,000 and now you credit 2,000. So that's set off lah. Zero rise. So there's no more account receivable after this. Yeah. Okay. So this is when you pay when you receive payment of accounts payable and then receive cash. Receive from accounts receivable. So what would be the need? Debit cash and credit your accounts receivable. Okay. So dia tak boleh penting. Right? So that is the journal entries when you have payment and receive from your payable and your receivable. So the next example is you taking a physical inventory. Okay. What happened is that all these that you record in your inventory accounts ni, right? So all this is what is recorded. Alright, bila you purchase, you record inventory. Bila you sell, then you masuk inventory. So all this is all everything is in accounts. But, alright, for example, you must also make sure that is what in your warehouse, alright, for example, because bila you ada inventory, you will have a place where you keep all your inventory, alright. So you must make sure that, okay, katalah dalam inventory balance is 1,000, alright, the value is 1,000. Assuming lah you ada 100 units at 10 ringgit per unit. So 100 times 10 is 1,000. So in order that is in your accounts. but you must also make sure that dalam you punya warehouse or even in your shop, all right, in your company, you must have 100 units, and each unit is 10 ringgit per unit. Yeah. So you have to make, so in for that, you will have to do a physical inventory take stock. Kita panggilkan stock take stock pula. Yeah. Stock take. So means that you take the how much is the actual inventory that you have in your company. All right. So we say that most company will do a complete physical count of the merchandise on hand at least once a year. Right. So what we do is that we are going to compute, all right, make sure that we are going to count. There should be 100 inventories, and each unit must have a value of 10 ringgit. Right? But remember that, all right, some inventory, all right, even though in account it shows that 1,000, but the actual value may not be 1,000. Right? This could be because of what we call inventory shrinkage. All right. For example, ada breakage, ada theft, all right, ataupun some of it has spoilage, all right, or damages. So all this is a normal business expenses. So katalah you kata okay dalam account ada 1,000, but when you do stock take, total value of your inventory is only 900. So ada dispute berapa? 100. Alright, why say that there's a dispute value? Because it could be the goods was taken ke, or the goods must be
Damaged.
damaged. Yeah, so because of that, the one in the accounts 1,000 is not the same as the one in the physical value, right? So in that case, which one you nak betulkan? Which one you have to correct? You nak correct the actual value or you nak correct the accounting value?
Accounting value.
You have to correct the accounting value. Yeah. So it means that you have to reduce lah. Initially we record that as 1,000. Now kita kena record ada expense of 1,000, 100. In this
100.
example, it says that dia kata inventory shortage of 2,200 is discovered. So in this case dia kata shortage already. Yeah, shortage of 2,002. So bila shortage dia jadi loss. Alright, it's an expense. So that will be recorded under cost of goods sold debit. So because the expense, yeah, it's a loss to you. Bila the spoilage and the damages, these are loss, these are expense, right? So you debit your COGS and you credit your inventory. So in our example just now, katalah the value now become 900, so the difference is 100. So you're going to debit COGS 100 and you're going to credit your inventory 100 juga. So in that case now, alright, your actual value is 900 and in your accounts now inventory is also 900. Then, alright, now you report correctly now.
900.
Otherwise, kalau if you do not take this adjustment, alright, you will over-report lah. Alright, you over-report you punya inventory at 1,000. Supposedly it should be at 900. So if you did not actually take up this inventory shrinkage punya transaction, then you will over-report, right? Over-report you punya inventory item. So that's why when we do audit, right, area of accounting, so one of the audit exercise is actually doing a stock take. So why? Because the auditor wants to just do a random checking, looking at the list of asset or inventory in your stock list, stock listing or inventory listing, and they will do, okay, I want to see item number 25, for example, right? It could be any of your inventory lah, and you must make sure that, okay, these are the inventory number 25, they must see the actual inventory. All right, or they could do some random checking. All right, I want to look at the 10 of the most value items, the most high value item of your inventory. So you must show the auditor lah that you actually have that high value item. Yeah, because why? If you don't have it, but it appears in your accounts, means that your accounts is not accurate. You have to do adjustment. Okay, so that is on a physical stock take, how you're going to record on the shrinkage. The next one is, okay, closing is okay. All right, now we go into the periodic. All right. So I mentioned earlier in the slide, is there that periodic inventory system is for company, a small company. All right, you only have one owner, or maybe you have one or two staff. All right, so this one is more for a small companies lah, where you do not need a computer system. All right, and most of the time you do manual. So what happened is that, and remember that the units, all right, the goods that you sell is a low cost value, right? Low cost, but then there are a lot of volumes. You sell a lot of those things, but each volume, each unit has a very low cost. Yeah. So in that case, you use periodic. So again, talking about periodic because it's meant for small businesses. The system, and remember that it shouldn't be complicated. So the system is simpler. All right. So it says that, for example, when you have periodic, all right, when you have periodic inventory system, when you purchase inventory, all right, the recording would be you debit your purchases, right? Because the name is you purchase inventory, you debit your purchase account. So here you do not have any inventory account. So if you're using periodic, you'll see that in your trial balance, all right, there will be no inventory account. All right. If you see there is an inventory account in your trial balance, then you know that that account is actually using perpetual inventory. Because why? Under periodic, there's no such thing as inventory account. So what they do is that whenever they purchase inventory, they just debit purchases, right? The name of the account is purchase, and you're going to credit whether it's cash or you credit your accounts payable. Depends. If you pay cash, then you credit your cash. Otherwise, you create accounts payable. It's a liability. But when you sell, remember it's simpler, right? When you sell also, you sell your inventory, then you debit your cash if you receive cash from your customer, or you create accounts receivable. All right. But again, credit, of course, you have to credit your sales account. So it's similar. Right. So it means that under periodic, you don't have this transaction. All right. This one is eliminated because why? Periodic is simpler. So they just record your cash or they just record your sales. All right. But when you pay accounts payable or even if you receive your accounts receivable, then the treatment is the same. All right, debit your accounts payable, credit your cash, or you receive cash, credit your accounts receivable. Yeah. All right. What happened when you have purchase returns is a bit different because why? Under purchase return of the perpetual accounts, all right, you're going to debit. All right, you're going to debit your COGS, right? Debit your COGS and credit purchase returns. Yalah, I can't talk now. Okay. Right, debit your COGS, credit your inventory. Right, whenever there's a purchase return means that you purchase your inventory and then you return to your is it purchase return? Yeah, I think it should be. Right, let's see just to double check. Yeah, cost of goods sold. Mana purchase return periodic. Tak ada pula. Okay, let me check first just to make sure. Purchase sales return. What is purchase return? I thought I saw it somewhere. It doesn't say. Okay, never mind. All right. So when you return your purchase, of course you credit your returns and debit your accounts payable. Accounts payable. Which one? I'm not sure. Sekarang ni. Okay, I have to check for that because if you have a sales return, you debit your sales return, credit your cash or accounts payable. So sini purchase return, this one is correct. Alright, the other one is debit inventory credit. Okay, betul lah. This one is COGS tadi. The other way around. Right. So purchase return means that you're going to debit your COGS because you take out your inventory and return back to the supplier. So you have to credit your inventory, and then you have to record the inventory that goes out into your cost of goods sold, even though it's not sold, but it's reflected in the cost accounts. Yeah. But if again, if you have under periodic, it's just that when you return your good to your supplier, either you receive cash or you're going to reduce your accounts payable. Similarly, if under periodic, when you have a sales return, means that you sold to your customer, and now customer returns goods to you, right? So you're going to have a debit sales return, and because of their return goods to you, either you have to pay them back cash or you have to reduce their accounts receivable. So if you look at here, sales return, all right, whenever you have sales return allowance, right, this is a contra account. Remember contra account? So it means that it's the other way. So if you're talking about sales is credit, all right, sales return is a debit, because why sales return is a contra to the sales account, right? Similarly, purchases, mana purchase returns, right? Purchase is debit, so purchase return again is a contra account. That's why it's a credit balance. Yeah, so whenever contra, it means that it's the other way around. Okay, purchase inventory at discount. So what happened is that, right? So discounts here, it talks about, okay, this is discount, all right? When manufacturer and wholesaler sell their products on account. So you're talking about your supplier sell goods to you, and they give you credit terms. They put that as 210 net 30. That's how you read it. 210 net 30. It means that, what does it mean? 2 is the percentage of discount. 10 is the number of days is available. It means that if pay within 10
Within 10 days,
days,
right?
then you get 2% discount. But if you pay within 30 days, then you have to pay the full amount. So let's say that the cost of the you buy from the supplier 1,000, right? No, let's make it 100 lah, 100, yeah, 100. But if
Okay,
you
so
pay
means
to your supplier, yes,
they mean within 30 days no discount.
no discount, yeah. And two for no
Okay.
discount lah,
Within 10 days only.
yeah.
Okay.
So, but if you pay within 10 days, all right, assuming that you have to pay them 100, but because you pay within 10 days, then you only have to pay 98. But that, because why 2 ringgit
No
is
discount
the
2%.
2% discount lah. Yeah, 2 over 100, 2% lah. 2% of 100 is 2 ringgit lah. Alright, that's why you only have to pay 98. So how are you going to record that? Alright. Okay, if you have to record that, right, discounts, right, you're going to, how much you pay, you debit and then you credit, right? You credit your accounts payable. Dia tak nak kawan I lah hari ni. Okay. You credit your, you have to pay cash. You pay cash how much? You pay cash credit of 98. Tak boleh. Okay, let's see. Mana ni? Okay, payments to supplier. So you're going to debit your accounts payable. In this case, you debit 100 because that is the amount that you record when you first purchase. Like when you first purchase, remember that we're going to record at gross, right? So you're going to debit you punya inventory when you purchase, right? And then you credit your accounts payable. How much? When you first purchase, you're going to credit your 100. All right, inventory is 100. But when you pay within 10 days, all right, in this case with discount, you are still going to debit because here you credit your accounts payable 100. So you must debit your accounts payable 900. But how much you actually pay? How much cash that you pay? Because how you pay within the discounts period?
98.
98. So how much is the discount that you receive? So if you look at here, right, your credit side is 98 plus 2 is 100, which is the same as your debit side. So discount received is 2. You have to record that as a discount received. Why do you think that the discount received must be credited? How do you see discounts here? Is it an income or is it an expense to you? When you receive discounts from your supplier. Anyone?
Again, Doctor, the question?
When you receive discount RM2 from your supplier, how do you see the
Okay.
discount? Is it an income or an expense to you?
Income.
Income. So bila income, that's why they credit, because income is revenue. Revenue credit kan? That's why whenever you discount receive, you're going to credit the account. And it makes sense that you the credit RM2, which is the revenue that you receive from the discount, and then you only pay out 98. And then 98 plus 2 is the same as the debit side, which is 100.
100.
Does that make sense? Okay, because your account payable masa you first purchase, you must record at gross. So ini, alright, the gross method, ya. Dia ada satu lagi what we call the net method. But I want you to apply the gross method because it's less confusing. So you just record when at the point of purchase, whatever the amount you are going to record at gross. But when you make payment, then you see whether you receive any discount or not. Then you take the transaction accordingly. Okay. Right. So this is what we talk about credit terms and cash discount lah. Alright, remember how to read it? 210 net 30. Net 30. N2 for net. Ya. Macam net. 210 net 30. Maknanya if you pay within 10 days, I give you 2% discount. If you pay within 30 days, then there's no discount. Full in pay in full lah. This one we are not going to do this recording purchase at net cost. This one we'll skip because we are going to record at gross. Yeah. Okay. Ini gross inventory and accounts payable, and then you have purchase discount taken. So that's your revenue. Right. And then returns of unsatisfactory merchandise. Right. Purchase from PC product. So this one is your debit your accounts. This one the purchase returns. Remember just now? Debit your accounts payable, credit your accounts, your inventory. Dia terus macam tu je. Oh, right. I nak betulkan sikit. Purchase returns, debit terus inventory. Dia tak ada ni. Okay. So dia sama dengan kat atas lah. Okay. Here you only have to debit your cash or accounts payable and credit your inventory when you have a purchase. It means that you buy from your supplier and then you returns to him. So you just credit your inventory account and debit your accounts payable. Or if you receive cash, then you debit your cash account. Next is right, transportation costs. Right, if the transportation, so it's normal that, for example, when you want to purchase, all right, it says that related to the acquisition of asset are part of the cost of the asset. So if you purchase asset and you have to pay transportation cost for the asset to be brought into the company, then the cost, the transportation cost will be added together with the total cost of the asset. Right, katalah you beli in this case buy an asset, let's say is a machine, right? The machine costs you 5,000 ringgit, but the transportation cost is 500. So now you have to put the cost of the machine is 5,000 plus 500. So the transportation cost on the purchases will be embedded into the cost of the asset.
Ma'am, in the Word file, can I see the Word file again, please?
This one? Yes.
Yes. So if you scroll up, so is it because in the Perpetual side we don't have any purchases? Like if you see the first,
no, you don't have purchase account.
That's why in purchase return it is directly inventory and no
yes.
purchase returns, right?
Yes.
Okay.
Yes. You only have purchases here, purchase and purchase return under periodic.
Okay. Else it's inventory when it's perpetual.
Yes. Yes. Okay.
Yes.
So this one is clear. Whenever you purchase, the transportation cost is embedded into the cost of the asset. All right. And then, okay, this is how you compute the net sales. right? So it means that when you want to compute net sales, you have to take the gross sales, the sales itself, and then you have to give sales return if there is any sales return and allowance, and there is any sales discount. So you have to take into account, because these, when you make sales, you sell goods, right? You sell good initially, the total cost is 912,000, but you have to give, there is a sales return of 8,000, and there's also a discount of 4,000, means that your net sales is only 900, because that is the net sale that will be taken, all right, in order to complete your gross profit margin, right? So sometimes you have to look at, also you just looking at the net sales. If the net sales percentage is very big, all right, it means that 900 over 912 is small, all right. But if I feel that net sales is 500, what happened? You have a sales of 912, but your net sales is only 500,000. Why you have so many sales returns where you give so much discount? So these are the things that you want to analyze further. All right. So normally they give you a certain percentage lah for net sale. It should be between, it should be at least 90%. Right. So if you say that, what is your net sales here? 900 over 912 is more than 90%. Where's my, tak jumpa pula. 900 over 912 is 98%. So it means that it's not an issue. But if you have less than 90% net sales, it means that why you have a lot of 10% to what happened. All right. If there are so much sales returns and allowance, then you have to look back the quality, for example. What happened to the quality control department? Or sales return too much, or sales discount. Why you give so much discount? Maybe it's not appropriate, all right? But if you can justify why you give discount, then it's okay. It's all about justification, yeah? All right, sales here, sales, what is this? Perpetual, so they make, this is the example of sales. Sales return, so debit sales return, credit account receivable. Let's check here. Debit sales return, credit accounts receivable, and debit your inventory, credit your COGS. So it's correct, all right? I will share with you. If you need these notes, I can share with you later, yeah? And then what else? Sales discount, similar. All right, sales discount means that it's an expense to you. What happened is that I sell you 1,000, but I will only get back 900. All right, so 100 is a discount. So that's an expense to you. All right, so whenever you give discounts, all right, that's why it's debited, because it's a contra revenue. Sales is a revenue, but sales discount is a contra revenue. That's why it's debited. And that sales discount reduces your revenue. Yeah. And cash, in this case, you only receive 980 instead of 1,000, because why? Because you give 20 discounts. And your account receivable is always recorded at gross. Number 2. For number 2, apa ni? Oh, lama. Okay. What else? Where were we? Okay. So this is a sales discount. Do you get the idea? Okay, sales discount. And then what else do we have? Delivery expenses. All right, delivery expense incurred by seller are debited to delivery expense. So for example, if you are the company, all right, then you make sales. On top of that, you have to pay. Now kan online everything, and you have to use Foodpanda for you to deliver, right? So in order for you to deliver, in that case, if you have to incur the expenses, the delivery is on you, then you have to debit that into delivery expense, then become your operating expense. All right, but I think that now with the online, all right, Foodpanda, Grab, who actually bear the delivery expenses? Buyer or seller? Buyer, kan? In that case, all right, we have to pay for the services. All right, but when you think about it again, all right, even though you have to pay for the Foodpanda's delivery services, delivery charge, but at least you don't have to go out, all right? You can save on your fuel,
Save
right? You
time.
don't save time, you don't have to look for parking
Yes.
or this thing, right? So for me, I just close my eyes lah. Yeah, RM5
Yes.
kan per delivery cost. So
No,
never
no need
mind
to
lah,
think others.
right?
Just receive the.
Support, support our business. Ha, kesian budak-budak food panda tu, right? Food panda,
Okay.
Grab, all this. But I think that is a good business for them lah, insyaAllah, alhamdulillah, yeah.
Yes.
Alright, okay, sales tax. Alright, normally kalau macam ni dikira macam what we had previously lah. But even though we have sales tax, right? So bila sales tax tu, you have to, because when you make sales, alright, kalau ada sales tax, in Malaysia berapa sales tax? 10%, isn't it? So example here is 7% tax, alright? So if the cost, if the selling price is 1,000, you have to pay additional 70 ringgit, right? Because why is
70
70
ringgit.
sales tax? But remember, the sales tax does not go into the pocket of the company. The sales tax belongs to the
Government.
government. All right. So you as a company you
Government.
just collect the tax on behalf of the government. So whatever that you collected is a liability. All right. So the sales tax that you collected, right, that is actually a liability to you, right? So because the money, whatever that you receive, you have to pay to the government later, right? In this case, the Royal Malaysian Customs, right? So whenever there's a sale that involves sales tax, then you have to take into account. In this case, all right, you receive, even though your selling price is 1,000 or your sales is 1,000, but what you receive is 1,070. Either you receive cash or the customer will pay you later. You're going to receive 1,070 in the future, but you have to break up. All right, 1,070 is made up of sales 1,000, and you also have sales tax payable. Why is it called payable? It's a liability. You receive that, but you have to pay that to government later. So it's not yours, it's a liability, right? So that's how you take up a transaction that involve sales tax. All right, you are not supposed to modify. And most business use special journal rather than general journal. Okay, this one is okay. Okay, so this is the financial analysis. Your net sales, as I showed you earlier, where sales minus your sales returns and sales discounts. All right, you want to look at how is actually your net sales percentage as compared to your, for example, your competitors. All right, or sales per square foot or selling price, all these things lah. Right, gross profit over net sales shows you gross profit margin, right? Because you want to know all this, gross profit margins should be 90%, right? Or 80%. If it's too low, then you have to see what happened, why your cost of goods sold, because remember that your gross profit over net sales, then you took into account gross profit is actually take up into your cost of goods sold, right? Your sales minus you have your sales minus COGS is your gross profit. Okay, remember that.
Profit margin.
So what happens if you have a very high COGS, then your gross profit will reduce. So cost, we do, when we say we want to make sure that we minimize your cost and maximize your profit. So if your COGS is too high, then something that you have to look into further. Okay, so we are done with your chapter 6. That is about 1 hour, yeah. Oh, not bad, huh? Okay. Let me see if we have a question that we can actually attempt. Uh, kat mana? Tak ingat. Find the. Give me a minute. Tutorial, isn't it? Tutorial kat mana nak cari ni? Tutorial chapter 6. Okay. Let's see if we have any question that will help us to further understand this topic. Okay. Can you see this now?
Okay.
Alright. Design. I tak ada draw. My Kenapa anak-anak I ada draw? Font, page border. I don't have draw. Tidak I boleh draw. Tak boleh. I don't have it. Right? Cannot draw here. Okay, let's see here. Bank tooling. Alright, this one under merchandising activities. Yeah. Bank bulk tooling reports net sales of 325,000, gross profit 175, and net income. What is that? You have sales 325, gross profit 175, net income of something. Kenapa dia tak habis?
Tak penuh soalan dia.
Tapi tak apa, you still can answer because in order for you to compute cost of goods sold, you only need the net sales minus
The gross profit.
gross profit or the other way around lah.
Yes.
Alright, so you can have, because you are playing with the formula, alright, you should have net sales minus COGS equals to gross profit. I cannot write here lah. I wish I could write somewhere here. Okay, so means that what would be your cost of goods sold? 325 minus 175. So it should be 150. Yeah. So you just use the formula lah. Net sales minus COGS, gross profit. So but now you don't have the COGS, then you have net sales minus gross profit. You should get your COGS. So the answer should be 150,000. Okay, Cik Wan? Okay. Which of the following should not be classified as inventory in the balance sheet of an automobile dealership? Which one should not be classified as an inventory? So when you're talking about automobile, you have to understand the business first. Automobile dealership means that the company is buying and selling of automobile, isn't it? So the inventory in this case is the automobile, because you buy and sell automobile, so your inventory is your automobile. So he said that we should not be classified. So would pickup truck offered for sale is an inventory?
Yes, inventory.
Yes, kan? Yes, because that should be lah. Used car taken in trade and offered for sale on the company's used car lot. Is this an inventory?
Yes.
Yes, all right, because normally automobile dealership not only they sell good motor vehicle or new one, but they also take up the used car. Yeah, spark plug, oil filter, and other parts which are intended for use by the service and servicing customer cars.
Yes. This is also inventory.
Yeah, this could be part of their punya supplies lah.
Yes.
Yeah. And then company cars provided to specific company for their personal use.
No. No, ma'am. This is not inventory.
Then what is it then?
This is
This is right.
benefits for the employees. So it's company.
Company executive for their personal use.
Yeah,
so this could be their asset.
Yes.
Yeah, because it's not for their sale, but it's for the use of the company. So it will be the asset. Okay, good.
Yes.
Okay, now the purchasing agent of Superb Service Company wants to know the dollar amount of inventory purchase on account during the year from a particular supplier. This invoice can be easily in Superb Service. How will you know how much is your accounts payable? We did not cover this topic actually, but it should be, I think that it should be in the accounts payable controlling account. Right, I did not go very detailed on this just now. Okay, next question is Sutton Supplies, net sales of 3750, net income and gross profit of 900. What is the cost of goods sold? So this question is similar to just now, right?
Yes.
So it's very easy. What would be your COGS?
It's not there.
Not there. It should be
2850.
Yeah, 2850, because why? You have net sales minus your COGS of 900. So you should get COGS of 2850. Next is that we have bulk tooling. Ini tak sama dengan tadi ke? Okay, done. Repeating there 2850 is there.
Yes.
Okay. Alright, under perpetual. Okay lah, periodic I went through just through the words tadi kan. Under the perpetual inventory system, which journal entry would indicate a purchase of merchandise? So when you purchase, what you do?
Is it A, debit inventory credit cash?
Why is it not B?
Because it's not perpetual, or like it's not periodic.
Debit purchase.
Purchasing is for periodic. Alright. And then
A or D? I forgot about it.
No, it has to be. When you first purchase, mana I punya tadi? When you purchase, perpetual debit inventory credit your cash accounts payable. So it's not your cost of goods sold.
Okay, that's
Cost
for
of goods sold tu bila you sell. Namanya goods sold.
Okay.
So bila ada sale, then only you record COGS.
Okay.
Okay? Alright.
Yes.
In the perpetual inventory system, merchandising transactions are recorded as they occur, correct? No effort is made to record the COGS until year end is wrong. Entities are made in the cost of goods sold account whenever merchandise is purchased or sold. COGS only when you sold, not when you purchase. So that one not sure.
Yeah.
Only for ever taking physical inventory is eliminated. That's wrong. So it should be A lah. Right, merchandising are recorded as they occur. Right, B is wrong. C is also wrong because COGS only when you sold.
Yeah.
So that's how you answer your multiple choice question. You have to take out whatever is not. Yeah. In a perpetual system, two entries usually are made to record each sales transaction. The purpose of this entry are best described as follows. A. One entry recognize the sales revenue and the other recognize the cost of goods sold. I would take that. A. B. To purchase is wrong. One entry to purchase the merchandise is wrong. One entry records COGS and the other reduce the balance in inventory account. That is one. Right, COGS and inventory is one entry. We're talking about two entries here. Yeah, so that is only on the first entry. One entry update the GL, the other updates are no, it's not. So it should be answer is A. Right. So I will share this question later. Right, that one I share with you later lah, the tutorial this part. Okay, Michael use periodic. Okay, when you use periodic, it happened that we have not covered this. Right, so since we have the question here, alright, so how does it work, periodic? Did we went through the periodic just now? Macam tak ke?
We didn't go through periodic.
Where is periodic? Ni periodic, right? So under periodic system, there's no entry made to inventory. So when you purchase, you debit your purchases credit your accounts payable. Right? And then when you want to compute COGS, so remember that I say that in periodic, you purchase, you debit purchase credit your cash. When you sell, you just debit your cash account and credit your sales. So there's no recording of COGS. Okay? So if in the accounts you see there's a COGS, you see there's an inventory, you know it's a perpetual. But if you see purchases account, then you know it's a periodic. Okay? So how do you decide on the COGS? Under periodic, you have to use this formula. Right? How to compute? So you're given the inventory, purchases, and closing inventory. So inventory, there are two types of inventory: opening balance and the closing balance. So what happens is that you are going to see how much inventory you have at the beginning of the year, and then you plus with your purchases, then you see that that will be the goods available for sale. Does it make sense? So it means that beginning of the year, you already have 14,000 inventory, which is from the previous year. So you bring to the current year as a beginning of the year balance. All right. Then throughout the year, you have a purchases of 130,000. So it means that from the purchases plus the beginning balance of inventory, total inventory available for sale is 144,000. Does that make sense? Okay. And then Remember, how do you know the value of your inventory under periodic? Right, you have to do the stock take. Whether you like it or not, right? You have to do stock take. Okay, let me put here why you do stock take. This one, to split cell. Okay, okay. Let me common one. Under when you talk about stock take, right? What do you call that? Physical count of your physical count of your stock, right? Under periodic is to match between your accounting balance and actual stock, right? That's why you do a stock take and then you do adjustment accordingly, right? Not most of the time, all right, you will have to do adjustment from your stock shrinkage. How you do the adjustment? You're going to debit your COGS because that's the cost of your, and then you're going to credit your inventory account. Right, because why? When stock shrinkage, then you have to reduce your inventory value, right? So that's why you debit your CGS, credit your inventory. But under periodic, you do stock take to determine your ending your ending balance of your inventory. Right? Remember that you don't have any inventory accounts. So how, in order for you to know how much is your actual inventory, then you have to do stock take under periodic. Right? So stock take is mandatory, both under perpetual and periodic, but it's more important for the periodic because otherwise you wouldn't know how much is the stock that you have sold throughout the year unless you know how much is the balance, right? So that's why mana ke tadi, for you to compute your COGS under periodic, all right, you have to look at cost of goods sold is 144, but when you do stock take, you only have 12,000 in the store. So it means that of all 144,000 inventory, and balance only have 12,000, means that the remaining, the 132,000 is no longer get, right? You no longer have stock value 130,000. So what happened to the stock? That amount is taken as your cost of goods sold. In other words, you have throughout the year, you have 144,000 inventory. At the end, you only have 12,000, means that you have sold 132,000. And remember that this is periodic, all right? You do not actually monitor your inventory from day to day. So that's how you have to do the stock take at the end. Then you know, okay, at the end of the year, I only have 12,000. So it means that the difference between goods available for sale and the closing balance is my COGS. Okay? Using the same formula, what would be your COGS here? You have a sales of 43,400, inventory beginning, inventory ending, and you have purchases. Anyone? Right, sekejap. Cik Wan buat, Cik Wan. I nak tengok boleh tak buat. Nak save, try save as PDF. Dah dapat belum? Okay. Okay. What will be your, how you compute your COGS here? You know that how to compute goods available for sale. You start with your opening balance. How much is your opening? Is your beginning is 11,200. They are not doing well. 11,200 plus purchases 32,200. I don't have it. I cannot write it here. Maybe I need to.
Plus,
Apa dia Cik Wan?
sekejap kita.
Katalah 11,200 plus
Plus 32,200.
purchases 32,200. Then you dapat goods available for sale. Kalau I tulis GAS. Boy, dia punya jadi tak lah. Okay, 11,200 plus 32,200. That is goods available for sale 43,400. Then minus your closing. Right, is 33,600. That would be your COGS. Dapat tak? So it should be 33,600. Yeah, okay. What is your gross profit? How to compute gross profit?
Sales minus the cost of goods sold. 9,000.
Yes, sales minus cost of goods sold. So how much is your gross profit?
9,800.
9,800, correct. Right, so this one is your sales minus your COGS. So how you get your COGS based on the earlier question. So if you got here wrong, then the second question is also wrong. So that's the yeah, not so good about your multiple choice question. Okay, and then prepare journal entries for the following, assuming the company use a perpetual inventory method. So you have and then you have a return, and then you purchase from Elizabeth Company, return 310 net 30, paid the amount owed to Martin Company, return 50, sold all the merchandise on hand from Martin.
Ma'am, I have a
Okay.
question regarding the inventory. It's in the Word file.
In the
Word file.
okay, hold on. All right, inventory.
So on the, if we consider the, can you scroll up? Yes. So yes, so on the perpetual side, we're using inventory. On the periodic side, we're using purchases,
Okay.
right? But when we come to purchase inventory at discount, gross method,
Mm-hmm.
so we use inventory for both of them, or do we change?
This one is it?
Yes. Is it like inventory for both of them, or do
Yes.
we use inventory for perpetual only and then purchases for the other one?
Oh yeah. Thank you for that. Okay. So hold on. I have to split the cell. Okay. Thank you for that. Command add. So similar to purchase debit. Is it debit inventory, credit your
Yes.
accounts payable? But here, what would be your when you have purchase
Debit
debit?
purchases, yes, and credit.
Yeah. Then credit your accounts payable. Okay. Thank you. What else do we have? Okay. So can you do this as your homework? Or you want to do together with me? All right, okay, I want you to do this later. All right, do the journal entries and you can use this as the reference, isn't it?
Yes.
Uh, I will share with you this later. Okay, so your homework is to do for your question number 129. Is that okay?
Yes, ma'am.
I will take this as your quiz number 2 lah.
Okay.
Yeah, so this one quiz number 2 on
Okay.
chapter 6. We have to do a lot of quizzes and something like this, so because that's the way you can help yourself. Yes.
We have quiz 2 left, which will be this. Then we have test 2, and we have 2 assignments, right?
Yeah.
Okay.
The assignment can only be done towards the end because we have the financial statement analysis.
Okay.
Yeah. Or you may have yeah. Okay. Right? Okay. So that is your chapter 6 ah. Habis dah?
Mhm.
Any question for chapter 6?
No, ma'am.
No?
No.
Okay. It's 8:59 now, so I will give a break of 10 minutes. And 9:10, we are going to start with chapter 7.
Okay. Inshallah.
Yeah, chapter 7.
Okay.
Uh,
It's 9 o'clock.